What if I told you that in early retirement you could potentially pay $0 in income tax, as well as avoid paying income tax on the pre-tax dollars in your traditional 401k as well? Intrigued? Stick around and let's find out how in this quick tip series. Hi, I'm Dr. Dang and you're watching The Financial Neurologist. I'm a board certified physician turned financial nerd, and together we'll take an evidence-based approach to personal finance. Note that I'm not a tax professional and this information is for educational and entertainment purposes only. And by watching this video, you agree that you are solely responsible for the tax consequences associated with your related accounts. Okay, let's get started. Fund your taxable brokerage and utilize the 0% long-term capital gains rate. If you're like most Americans who have an employed position, your primary source to retirement would likely be a traditional 401k. A traditional 401k is an amazing tool that allows you to set aside pre-tax dollars towards your future. However, it's not without its drawbacks. You see, if you try to withdraw money from your 401k before the age of 59 and a half, you'll be hit with a 10% early withdrawal tax penalty. And no matter what age in which you withdraw money from your traditional 401k, you still have to pay regular earned income tax, which starts as low as 10% but can go up to as high as 37%. Now here's the secret to avoid doing this and potentially boosting the overall value of your portfolio. First, you need a very important tool, and that is having at least 5 years of annual fixed cost in the form of savings and or a taxable brokerage account before we can move to the next step. So withdrawing cash from your high yield savings account is a no-brainer. You don't pay any taxes on this amount because it's after-tax dollars. You already paid the income tax on it. It gets more interesting though when you start to withdraw from your taxable brokerage account to provide your annual income. You see, since taxable brokerage accounts contain capital assets that were purchased with after-tax dollars, when you sell these assets, the income generated is counted separately from earned income, noting that your long-term capital gains tax rate still depends on your earned income. So the secret is that if you're fully retired and don't have any employed earned income, the amount that you can withdraw from your taxable brokerage account while still paying 0% in federal income taxes using the long-term capital gains rate could be quite large. Now let's go over a case study to see how this is done. Let's say, for example, John has retired with $1 million in his brokerage account. He figures that he'll follow the 4% rule and withdraw $40,000 per year to cover his annual living expenses by selling some of the stocks that he owns in this account. Let's also say that 40% of this amount is his basis, or in other words, the original after-tax dollars that he put into this account, and 60% of this amount represents his capital gains. To translate that into numbers, $16,000 is his basis, which is not taxable because it's after-tax dollars. The remainder $24,000 represents his capital gains, which is his taxable income for the year. If John was single and filing jointly in 2024, up to $47,025 of long-term capital gains is taxed at the 0% rate. And in addition, the 2024 standard deduction adds an additional $14,600 on top of this amount that would fall under the 0% rate. So in summary, John could realize in 2024 $61,625 in capital gains while paying 0% in federal income tax. Combining this with his basis representing 40% of his portfolio, he could withdraw a total of $102,708 without paying federal income tax. Cool, isn't it? This gets even more powerful if you're married. So let's take the same scenario, but say John is married and files jointly with Beth. They have a portfolio of over $5 million and they want to withdraw $100,000 annually to cover their luxurious retired lifestyle. If they did this in 2024, they can withdraw up to $94,050 in capital gains while paying 0% in federal income tax. And in addition, the 2024 standard deduction for a married couple adds $29,200 on top of this amount that would fall under the 0% rule. So in summary, John and Beth could realize in 2024 $123,250 of capital gains while paying 0% in federal income tax. Combining this with their approximated basis representing 40% of their portfolio, they could potentially withdraw a total of $205,416 without paying federal income tax. The current tax law favors early retirement for a married couple. Pretty cool, right? Now for the next step. Roll over your 401k into an IRA. So most of us have a traditional 401k with our employer, and it may have awesome low-fee Vanguard fund options, but nothing beats the flexibility of an IRA that you have full control over at the brokerage company of your choice. And in order to proceed to the final step of reaching the holy grail of paying 0 federal income taxes in retirement, you have to roll over your traditional 401k into a rollover IRA at your brokerage company. Luckily, this step is relatively simple. Open up a rollover IRA at your brokerage company and contact your 401k administrator and ask to initiate the rollover process. This usually takes 1 to 2 weeks to complete. Now onto the final step. Perform annual Roth conversions up to the standardized deduction. I want to take a moment here to clarify the difference between direct Roth IRA contributions and backdoor traditional to Roth IRA conversions. As of 2024, these contribution limits are $7,000 annually, but note that this limit does not apply to rollover IRAs. There are no Roth conversion limits for Roth conversions conversion from rollover IRAs, but the amount that you convert from your rollover IRA account to your Roth IRA account would count as taxable income for that year. And after 5 years, any amount within that Roth IRA account could be withdrawn at any time, totally tax-free. So this is the key step. Pay attention here. During the initial 5 years of early retirement, while you're doing these Roth conversions, you need to lean into withdrawals from your cash savings or taxable brokerage account at the 0% long-term capital gains rate to cover your annual fixed costs. Okay, now starting the first year of retirement when you have $0 in earned income, you should start doing annual Roth conversions up to the standard deduction in order to pay $0 in federal income tax for this conversion and $0 in federal income tax and distributions later on. So let's take a case scenario. John is filing a single for 2024. He just retired. So this means that he can go into his rollover IRA account and click the convert to Roth button of up to $14,600 without paying any federal income tax on this amount to provide himself with enough annual income to cover his expected fixed cost. Now let's take the same scenario and apply it to a married couple. John and Beth are married and filed jointly, and they can start doing annual Roth conversions up to the standard deduction of $29,200 while paying $0 in federal income tax for this conversion. They also are living off of their cash savings as well as taxable brokerage account at the 0% long-term capital gains rate to complete conversion of the rollover IRA to Roth IRA. Now here are the key benefits of doing this. You would have effectively taken pre-tax dollars from your traditional 401k, converted to a Roth account without paying any federal income tax. And afterwards, you're free to enjoy your earned income while effectively never having paid taxes on it on the front end or the back end. That is a powerful way to retire. So additional benefits of a Roth IRA include no early withdrawal penalties. You can start withdrawing from your Roth IRA account at the age of 35, 40, 55 if you want to, without paying any penalties or income tax. There are no required minimum distributions that forces you to withdraw from this account at the age of 72 like you would have with a traditional 401k. If your children inherit your Roth IRA, they wouldn't be hit with a tax bomb following the 10-year withdrawal rule of inherited IRAs. Not paying taxes on an inheritance sounds good to me. Utilize the federal premium tax credit to subsidize your health insurance in early retirement. The premium tax credit was established as part of the Affordable Care Act to subsidize the cost of private health insurance for low and middle income families. As of 2024, if you're an individual with an annual realized taxable income of $43,740, your expected contribution towards premium would represent 6% of your income, which means that you pay $219 per month towards your premium, and the rest would be covered by the premium tax credit. Similarly, in 2024, if you're a married couple with 2 kids and your annual taxable income comes out to $90,000, your expected contribution towards premium would also represent 6% of your income, which means that you pay $450 per month towards your premium, with the rest being covered by the premium tax credit. This could represent a savings of tens of thousands of dollars per year. In the end, these tax drawdown strategies during retirement are really just using the existing tax laws to help you live a rich and fulfilling life in retirement. If you found value in these videos and want more useful financial insights, hit that subscribe button, tap the notification bell, and be a part of our journey. Stay tuned and keep thriving.